The chart of accounts is the structure your bookkeeping software runs through. Every transaction lands in a bucket, and the buckets are what your quarterly P&L review reads from. Build the structure right one time at setup, and every report after that produces useful information. Skip the structure or compromise it, and your software is producing the bank statement back to you with a category column. Think about what a single line item actually obscures. The 80% that came from one corporate client looks indistinguishable from a healthy spread across 30 individual clients. The program that broke even but cross-sold 3 one-on-one engagements looks identical to a program that drained your calendar for nothing. Same total. Two very different practices. These three reasons are not equally weighted in any given quarter. Pricing tells you whether the rate sheet is working. Tax handling keeps the practice out of a quiet sales tax liability that compounds while you ignore it. The mix shift is the early warning system. By the time the cash hits, the trajectory has already been visible in the proportions for 2 quarters. A note on why these are split the way they are, rather than collapsed into 3 or 4. The IRS does not care whether you call something coaching or instruction, but a state revenue department cares deeply whether you sold a recorded course versus delivered a live session. Each bucket here either earns its own line because the tax treatment differs, or because the engagement economics differ enough that mixing them turns the P&L back into a bank statement. Read this slide as a decision trigger, not a data point. When one-on-one trends down and courses trend up, the conversation is not whether the practice is healthy. Total revenue might be identical. The conversation is whether you have the production infrastructure for a course-heavy quarter and whether your reserve methodology assumes a sales tax footprint you used to not have. 2 operational decisions surface from one quarter shift. Build discipline early. Set up all 8 buckets in the software, even if today's balance is 0 on 7 of them. 0 buckets cost nothing to carry. Adding a bucket mid-year after you start a new stream creates a gap in historical comparison that does not close. Q1 has no course revenue line, Q3 does, and the year-over-year red for that bucket starts a year later than the activity did. What Jordan got out of the retroactive cleanup was not the percentages. Those existed all along, just invisible. What he got was the realization that 20% of the year was now group work he had been pricing as if it were one-on-one, and the courses he treated as a small experiment had become 5% of the revenue without a sales tax registration in any of the states the buyers lived in. Buckets gave him a problem to solve, not a category to admire. Buckets surface problems. They do not prevent problems. They surface them while there's still time to act. A sales tax question caught in Q1 is a registration and a quarterly filing cadence. The same question caught at year end is a backfiling exercise plus penalty interest on uncollected tax. The coach now owes out of pocket because the customer is long gone. One practical note on the import. Both QuickBooks Online and Xero will accept the template, but neither will warn you if you skip a bucket and then start receiving revenue against it 9 months later. The cheapest moment to add every bucket is at setup, with 0 balance on most of them. The second cheapest moment does not exist. Every later add costs you historical comparability you cannot recover.